You open your phone at night just to check the markets. Bitcoin is up 12%. A random coin you almost bought is up 40% in a week. Social media is full of screenshots showing five-figure gains from people who started with only $2,000. Meanwhile, your savings account earns almost nothing. Your paycheck feels stretched. Rent went up again. Groceries cost more. And you think, maybe this is my chance. Maybe this is how normal people finally get ahead. So you move $3,000 into crypto. It feels bold. It feels smart. It feels like you are finally playing the same game as the wealthy. But a few months later, the market drops 35%. You do not sell. You wait. You hope. And quietly, your emergency fund is smaller than it was before. Here is the uncomfortable truth most people never hear. Crypto is not what keeps the middle class poor. The behavior around it does. The real trap is chasing explosive returns before building financial stability. Middle-income earners often invest in high-volatility assets before they have a 6-month emergency fund, before they eliminate credit card debt at 22% interest, before they build steady retirement contributions. That order matters more than the asset itself. When your foundation is weak, every price swing feels personal. You panic sell at minus 30%. You double down after a 20% surge. Here is what most people miss. Wealth is rarely built through sudden jumps. It is built through boring, repeatable systems. Crypto becomes a shortcut mindset, and shortcuts usually skip the step that actually creates lasting security. Think of your financial life like building a house on land you cannot see. The visible part is the exciting stuff. The rooftop deck, the glass windows, the modern kitchen. Crypto feels like that rooftop deck. It is flashy. It gets attention. People point at it and say, that looks impressive. But beneath the surface is the foundation. Concrete, steel, deep supports anchored into the ground, emergency savings, low fixed expenses, consistent retirement investing, insurance. Those pieces are invisible. No one brags about them online. Yet without them, even a beautiful house cracks under pressure. When a storm hits, the deck does not matter. The foundation does. Market crashes are financial storms. If you build the roof first, you risk collapse. If you pour the base first, you can add whatever you want later. The trap is mistaking visibility for strength. Before discovering this rule, many middle-income earners think investing is about picking the right asset. Surveys of American households regularly show a fragile reality. Roughly 37% of adults would struggle to cover an unexpected $400 expense without borrowing or selling something. That single number explains more about middle-class stress than any crypto chart. If a small car repair can disrupt your month, imagine what a 30% market drop does to your sleep. Research also shows that investors without emergency savings are far more likely to sell during downturns. Not because they lack intelligence, but because they lack breathing room. When money feels tight, volatility feels threatening. Here is what most people miss. Crypto is not competing with other investments. It is competing with your financial stability. And stability, not excitement, is what allows wealth to compound over time. Let's walk through simple math. Imagine you earn $70,000 per year after taxes. Your monthly expenses total $3,500. That means you need $21,000 for a 6-month emergency fund. But instead, you invest $10,000 into crypto because it feels like a faster path. The market rises 25%. Your account becomes $12,500. You feel brilliant. 10-8 falls. 40% from the peak. Now your balance is $7,500. On paper, you are only down $2,500 from where you started. But if you suddenly lose your job, you cannot pay 6 months of bills. You are short $13,500 in security. That gap forces decisions. You might sell at a loss. You might use credit at 18% interest. The opportunity cost is not just the $2,500. It is the stress, to debt risk, and the lost time rebuilding stability. Reaching financial stability requires an identity shift. Instead of seeing yourself as an investor chasing upside, you begin seeing yourself as a builder protecting structure. Builders think in layers. First safety, then growth. When you adopt this mindset, your habits change automatically. You automate $500 per month into a high-yield savings account until it reaches your target. You prioritize paying off a $6,000 credit card balance before buying another speculative asset. You track monthly expenses, so you know your true baseline number. This identity removes urgency. You are no longer desperate for a breakthrough year. You are constructing a durable life. Crypto, if you choose to own it, becomes a small satellite around a strong core. That shift reduces emotional swings. It replaces impulse with allocation, and over time, consistent builders quietly outperform emotional chasers in both wealth and peace. Now consider how this foundation changes real life. With 6 months of expenses saved, a toxic job feels less permanent. You can negotiate salary with confidence because you are not one missed paycheck away from crises. You can turn down overtime that damages your health. You can take a calculated career risk, such as learning a new skill or switching industries, because your bills are covered. Compare that to the investor who put every spare dollar into volatile assets. When markets drop, they delay doctor visits. They postpone moving to a better neighborhood. They avoid asking for raises because stability feels fragile. Here is what most people miss. Financial freedom does not begin with $1 million. It begins when short-term survival is solved. A strong base also changes spending. Instead of upgrading your car after one good year in crypto, you maintain the reliable vehicle and keep investing steadily. Obera decade, that discipline compounds into options. Options create leverage in career decisions, housing choices, and family planning. Stability widens your future in ways a quick gain never can. The biggest mistake people make after building some savings is they feel secure with $20,000 in the bank and immediately increase speculative risk. To make up for lost time, they tell themselves they deserve a shot at doubling money quickly. This is another trap. Security is not a signal to gamble harder. It is a platform to diversify calmly. When your emergency fund is complete, the next step is consistent long-term investing, not swinging for 10 by returns. Another mistake is measuring success by short-term performance. If a friend turns 5,000 into 25,000, comparison creeps in. But you rarely see the losses posted online. Chasing someone else's highlight moment often destroys your quiet progress. Protecting your base must remain the priority even after confidence rises. Zoom out for a moment. The real question is not whether crypto will rise or fall next year. The real question is how you design a life that withstands uncertainty. Every dollar has a job. Some dollars protect today, others build tomorrow. When protection dollars are misused for speculation, you weaken the system. The opportunity cost is invisible but powerful. Money that could reduce stress ends up increasing it. Time spent recovering from losses, delays, retirement contributions. Compounding thrives on consistency, not drama. A person investing $800 monthly for 20 years often surpasses someone chasing unpredictable spikes. The big picture is simple. Stability first, growth second, optional risk. That sequence turns investing from a gamble into a strategy. It transforms markets from threats into tools. If this message challenged how you think about fast gains, good. The goal is not to criticize crypto. It is to protect your foundation, build your emergency fund, eliminate high-interest debt, automate steady investing. Then, if you choose, allocate a small portion to higher-risk assets without risking your future. Wealth is built quietly, layer by layer. If this helped you see the trap more clearly, like this video, share it with someone chasing quick money, and subscribe to creditclever4.com/practical financial guidance designed for real middle-income lives.